Welcome to the Max Retirement Show, where our focus is to help you retire and maximize your retirement story. A lot of people feel like their tax rates are going to go down in retirement, but reality is, well, for some people, yes, but for some people that may have saved $1 million or more in their retirement savings, they might be hit with some unexpected tax traps in retirement that could be potentially costing them thousands of dollars in extra taxes. So, on this week's show, we're going to talk about the 3 retirement tax traps that could hit you when you least expect them in retirement, and then some simple strategies to help you potentially avoid those retirement tax traps, keeping more of your hard-earned retirement savings with you and in your pocket versus giving it to the IRS. Continuing on the theme of taxation as we go into our trending retirement news segment, we're going to talk about the taxation of Social Security and some trending news on whether or not it may be eliminated. And then we're going to end up with our listener question of the week, all about Social Security and whether this listener should claim it or delay claiming it because they have enough in their retirement, well, not the retirement savings, the regular savings to maintain their lifestyle. And for those that are new to the channel, my name's Scott Sierens. We run a retirement planning and investment management firm where we help people increase their retirement income, help them reduce their taxes on their IRAs and 401ks, and optimize their investments to maximize their retirement story. Think about this. During your working years, you had taxes withheld from your paycheck. So for a lot of people, they weren't actually paying attention to the taxes that they were paying out each and every year. But in retirement, every dollar that you take out is basically a tax decision. And so it's really important that you focus and understand on the tax impacts of your retirement withdrawals. So the first potential tax trap in retirement is required minimum distributions pushing you up into a higher tax bracket. Let me just use this kind of simple thought process around this. During your working years, you're stuffing dollars into the retirement savings bucket. You're just going to keep putting money in that bucket. The goal is for that bucket to grow. And technically, don't have to touch that bucket. Wait until, right now, age 73 or 75, depending on when you were born. And at that age, the IRS is going to tell you that you got to take that bucket and you have to start pouring it out. And when you're pouring it out, some of the money needs to go to IRS because you haven't paid any taxes on that money yet. And so that's required minimum distributions, them forcing you to pour the bucket out. But the surprise is the tax dollars that you're going to pay on that money as you're pouring it out of the bucket. And a lot of times people think, well, I'll just wait until required minimum distribution age hits, and then I'll kind of focus on it then. But they're probably going to come to the surprise of how much their RMDs could be at those ages. I just ran some examples for you here. For example, if you have $1 million in retirement savings at age 73, your required minimum distribution is going to be around $37,700. At age 85, if you still have $1 million in your retirement savings, your required minimum distribution is going to be around $62,000. Let's say you have $3 million in your retirement savings. Age 73, your required minimum distribution right now would be around $113,000. Let's say you get growth, you're taking money out, but you get growth in that account. That same account, $3 million at age 85, your required minimum distribution would be $187,000. So this is what led to shock for a lot of people that we meet with when doing a tax projection. One quick example, met with a couple that had $3 million in their retirement savings. They were making a very decent salary right now, around $200,000. They were big savers, putting all of that money away. When we did the projections, due to those required minimum distributions later on in life, it was showing that their taxable income in the future could be nearly the same, and in some years, more taxable income in their future than where they were at today, therefore leading to higher tax rates in their future than where they were at today. And of course, it all depends on where tax rates go. So required minimum distributions can lead to quite the surprise for some people in how much taxes how many tax dollars they'll be paying out in retirement. Now, there are some potential strategies to help reduce that. Some of the strategies that we utilize with clients are Roth conversions, strategic withdrawals earlier on in retirement, meaning not waiting till RMD age, and then also taking a look at QCDs, qualified charitable distributions, when you're age 70 and a half or older. The second tax trap that surprises a lot of people in retirement are Medicare IRMAA surcharges. Medicare premiums are based on the amount of income that you have coming in. And if your income surpasses certain thresholds, your Medicare premiums may go up by different amounts. That's what Medicare IRMAA is. And what I find is that people aren't aware of this going into retirement, and sometimes surprised because there's a 2-year look back on this, meaning your Medicare premiums today are based on income that you made 2 years ago. Now, what could count as income? Well, it could be your wage income, your Social Security income, it could be Roth conversions, it could be withdrawals from your IRAs and 401ks. Anything that's taxable income gets considered as part of this. So you need to understand all of the different parts of income that you're not only taking in today, but how that's going to impact you 2 years from now. So some common mistakes that I see made are some large withdrawals from, like making large withdrawals from your IRAs or 401ks to make one-time purchases. Those large withdrawals, if they put you over certain thresholds, your Medicare premiums are going to go up in a couple years. Doing Roth conversions without considering where the Medicare IRMAA thresholds are. And then required minimum distributions. So required minimum distributions that we already talked about, not only potentially causing higher taxes in your future, they might also be causing higher Medicare premiums in your future. So some simple strategies, I wouldn't say simple, but some strategies that we go through with clients when helping them plan for their future and helping them do their best to reduce the taxes they'll pay to the IRS is putting together an income plan with a tax-efficient withdrawal strategy. Which accounts do we take from and when to do our best to keep below different Medicare IRMAA thresholds? Looking at Roth conversions, looking at strategies before age 63, because 63 will start to dictate your age 65 Medicare premium. So doing some tax strategies prior to age 63 to help reduce those Medicare IRMAA surcharges. And then the other thing is sometimes spreading large withdrawals over multiple years, which makes me kind of think of a quick story here. I had a client who just wanted to take money out to purchase a car. Well, what we did is we structured it that they took some out in December and then some out in January. Based on their situation, that helped them for the first year stay under the Medicare IRMAA thresholds, as well as that second year. So strategically thinking about your withdrawals, adding in some tax strategies can potentially help you avoid this second tax trap of the Medicare IRMAA surcharges. The third tax trap is one that impacts married couples, and we call it the widow's tax. And you need to think about, if one of the two of you were to pass away, what are all of the different impacts to the remaining spouse? Well, first off, from a tax standpoint, they will need to start filing as a single filer versus as married filing jointly, which could potentially lead to higher tax rates. Also, they lose one of the two Social Security benefits. They keep the higher of the two, meaning most likely they're going to have to go to their retirement savings to take out more money to maintain their lifestyle. That more money that they're taking out is most likely taxable income, leading to, again, higher taxes. And then the other thing is that a remaining spouse still has to take required minimum distributions for both spouses' retirement savings, meaning, again, increased income and potentially increased taxes. And then the last thing is that all of these other things are leading to increased income. Now that remaining spouse might be hitting IRMAA thresholds because of all of the income that they're taking in. So there's a lot of potential what ifs there when it comes to that remaining spouse. A good example is kind of the one I was using earlier with that couple that had saved up $3 million in retirement savings. They were already looking at a higher tax bracket with the two of them alive, and then running some scenarios that if one of them were to pass away, the remaining spouse was definitely going to jump up into a higher tax bracket. Again, all projections, but jump up into a higher tax bracket and hit IRMAA thresholds with Medicare premium surcharges. So planning ahead, planning early is really important to try to help avoid, one, the pains of this and the potential extra taxes if a spouse were to pass away. So putting together an income plan early on is really important. Then again, having a tax efficient withdrawal strategy, which accounts are you going to take from and when. Doing that early on, looking at Roth conversions early on as a married couple versus a widow or widower. And then selecting the appropriate benefits when it comes to Social Security or pensions. Looking at fully understanding the survivor benefits on those accounts. So that way you know that if one person passes away, how much income will the other person have coming in, which will also help them understand how much they're going to have to go and pull from retirement savings to continue to maintain their lifestyle. So again, some strategies that we're using with clients to help them, again, try to avoid some of this pain as much as possible. And it's really, really important to take a look at that. I'm guessing if you're watching this, taxes are on your mind. If you're wondering some additional ways to potentially reduce taxes on your IRAs, 401ks, 403bs, you might want to take a look at our free guide to unlocking hidden tax savings opportunities. You can get that at maxretirementshow.com/taxes. Continuing on the theme of taxes, let's talk about what's trending in the news right now and some proposals that are making headlines when it comes to Social Security and taxes, and potentially eliminating the tax on Social Security. Not only having a huge impact on retirees, but also those that are still working. Let's take a look at the headlines here. First is from U.S. News. Trump proposed eliminating Social Security. Here's the bill that can make it happen. First, let's understand how Social Security gets taxed. They just had a really good simplistic version of this here. Basically, if you're single and your income is exceeding $25,000 or married filing jointly with income exceeding $32,000, up to 50% of your Social Security benefit becomes taxable, meaning adds into your taxable income. If single, $34,000 or married filing jointly with $44,000, up to 85% of your benefits may be taxable. So on February 6th, there was the Senior Citizens Tax Elimination Act that was proposed. Very short and simple bill. It just says that we're not going to tax Social Security anymore, full stop. There's obviously some pros and cons to this, and I thought this other article here from Penn Wharton, it was eliminating income taxes on Social Security benefits. I'll link to all of these in the show notes. Talks about two key points. One, they feel like revenues would decrease. It would reduce revenues by $1.5 trillion over 10 years, increase federal debt by 7%. What does that mean to me when I say here increase in federal debt? Well, does that mean that there's going to be future taxes then to pay for this at some point in time in the future? Projected depletion date would accelerate from 2034 to 2032. High-income households would gain more than $100,000 in lifetime welfare. Those under 30 would be worse off, losing about $10,000 in lifetime welfare. So, first off, the bill hasn't passed. It's just good to know information. Would I say to bank on it? We don't know yet. Could happen, might not happen. Things could even change before this video goes live. But I just want to kind of go through some pros and cons and thoughts of this proposal here. First off, some pros in regards to this. Well, if you're a retiree, this is going to help increase your income because your Social Security doesn't get taxed. For those higher income retirees where Social Security adding into your other taxable income is pushing you into higher tax rates, this could potentially save you on taxes as well. And that's why it showed such a big increase for higher income individuals. Now, some downsides to this. First off, it talked about depleting the Social Security Trust Fund faster. So at some point in time, Congress is going to have to address this. And what does that mean? Well, probably means that the way to address it is they're going to have to tax more income, find the tax money somewhere to keep the trust fund going. Or if they don't, while you might have saved money on taxes, guess what actually happens is that now your Social Security just gets reduced in the future. So kind of some downsides you have to kind of think about, make sure that Congress is preparing for that. The other is that if you are a higher income individual, one thing that right now is the Social Security tax caps out in like the mid $100,000 of income. Well, to cover this, maybe they, instead of capping that off there, they might get rid of that cap, meaning that you'll pay more Social Security taxes on your wage income for higher income individuals. So just good to know information, good to know how it can impact you in all of the different ways. And last up for today's show is we have our listener question. This one comes from Stan. Again, a few months old, so Stan, probably thanks for waiting for the answer. You've probably already come up with your answer, but I thought it'd be really helpful for actually everybody else that's watching this and wondering some of the similar things about Social Security. Stan says, I'd planned to start my Social Security last year, and I just never got around to it, so I've just been pulling money out of my savings account to help cover expenses each month. I actually have enough cash to continue doing this for another year. Should I just keep doing this and put off Social Security for another year? Stan, that's an excellent question, and a lot of times people just jump right into taking Social Security without thinking about when is the right time to claim it. Now, we don't know every detail in regards to Stan's life and financial picture and how much he has in retirement savings. And you might be thinking, Scott, what does that even matter? Well, it all matters a lot. And so while we can't give Stan a defined answer of yes or no, I want to talk about the different things that you should consider when it comes to taking Social Security, especially as Stan is talking here. So the first thing is longevity. How long do you plan to live? Now, usually the break-even age for Social Security is in the early 80s, meaning if you think you'll live into your 80s and 90s, well, waiting longer to take it, you'll get more benefit back from Social Security. However, you have to have some health issues and you're not sure how long longevity might take you, well then maybe it does make sense to take it earlier. A lot of people stop right there and don't take the other things into consideration. So let me talk about the other points that you also want to consider. Another point is how much do you have in your retirement savings? Because if you have a ton in your retirement savings where Social Security won't make a huge impact on it, then maybe the timing doesn't make as big of a difference. But if you don't have enough in retirement savings and you take Social Security too early, plus not having enough in your retirement savings, you might end up having to reduce your lifestyle throughout retirement. The next point that I want you to consider is that if you are married, you have to think about survivor benefits. If one spouse were to pass away, the remaining spouse keeps the higher of the two benefits. Simple terms, one spouse passes away, you only keep one of the two Social Security benefits and you keep the higher of the two. And then the last item to think about is the cost of living adjustments that Social Security provides. So the longer that you let your Social Security grow, the bigger number that the cost of living adjustment will go on, meaning that the longer that you let it go, the bigger the raises that you'll get throughout your retirement. 4 different points to consider. Going through those points, you might decide to take it early. Going through those points, you might decide to wait. Or if you're a married couple, maybe one takes it earlier and one's waiting till at least 70 due to the survivor benefits. Hopefully this gets you thinking about Social Security, your Social Security, and the right dates to claim it. Hey, I just hope that you found all the different segments in this show helpful and of value. If you are looking to hear more information and value in regards to how to potentially reduce the taxes on your IRAs, 401ks, 403bs, more about Social Security and more about retirement, well, subscribe to our show so that way you get notified as we're coming out each and every week with new information on topics just like those to help you out. Thanks for joining. Hope you have a great day.